Last episode I told you that every transaction leaves two footprints. But here's the problem, you can understand it, but you can't see it. As soon as money starts moving through a business, it stops being simple. So we need a way to see those footprints clearly, not in theory, but in a picture. And that picture is, well, before we draw the picture, we need to know what it is we're drawing. We're drawing individual accounts. Think of an account as just a container with a label on. For example, a bank account, it records money going in, money going out. A sales account records all the sales that you've made. An expense account, like your phone, insurance, electricity, fuel, just records the expense that you've made. Each account only tracks one thing. So instead of being a big messy pile of money and activity, everything is labelled, everything's in its own container. Each container is an account. And every financial transaction leaves two footprints. It leaves one footprint in one account, and it leaves another footprint in another account on the opposite side. Let's draw the account. It's one of the most simple diagrams in accounting. It is a T account. It looks like this. It looks like a letter T. This diagram has been used for over 500 years. Basically, it's got two sides, left, right. The left is, we call it debit, and the right is the credit side. From previous episodes, if you remember, we enter amounts on the credit side where money comes from, or on the debit side where money goes to. You're going to hear these words a lot in bookkeeping and accounting, debit and credit. Just think of them as left and right. Debit's left, credit's right. Don't think of them as anything else. It can get a bit confusing because sometimes you get a message from your banking app saying, you've had $100 put into your bank account, we've credited your account. And you think, great, credit means positive, that's great. Forget that. Credit doesn't mean positive, debit doesn't mean negative. They're neutral words, they simply mean left and right. The reason the bank says we've credited you is because in their books, they have credited you because they owe you the money, so they credit it. In your books, it would be a debit on your side, but just forget that they've said credit. Doesn't mean good, doesn't mean bad. They're completely neutral words. Now, let's go back to the build-up from our previous episode. Remember, so we're going to need a couple more accounts actually. Let's draw one here. This can be sales. And we'll need another one. We'll need a debtors account. We'll have that here. This account is debtors. Debtors are people that owe us money. It's the opposite of creditors. You may have heard of creditors. Creditors are people that we owe money to, and debtors are people that owe us money to. We're going to call this account that we've previously drawn the bank account. And do you remember back in October we made a sale, so we record it, even though no money had transferred at the time because the sale was on credit. We still need to record it, and we sold him $40,000 worth of sales. So we enter 40,000 on the credit side. Now we need to make an equal and opposite entry in another account. So the money came from our sales and it didn't go into our bank because it hasn't paid yet, it went into debtors. So we debit the debtors side with 40,000. It's one transaction, so it's the same amount. One's on the left, one's on the right, they both balance. Then in January, the client paid 40,000. Then the money came into our bank, 40,000. Came in on the left side, the debit side. We have to do an equal and opposite entry. It didn't come from sales because we've already recorded the sales. We can't record it again. It's come from debtors, 40,000. So we've made two entries. It's come from debtors. It's gone to the bank. Credit entry, debit entry. If you look at debtors, that now balances off. His debt's gone, and we've got our $40,000 in the bank. So we can follow the movement of the money. It's never created out of nowhere, and it never disappears, it never vanishes. It comes from somewhere. In this case, it came from the sales and it moved to debtors. Then 3 months later, it moved out of debtors and into the bank. one flow of money. It's easy to see where it went. Back in October, when the builder had made the sale, he might have seen the sales and thought, I've made 40,000. Where is it? It's not in the bank. It was here waiting in debtors. Now you might think, I don't need a system to do this. I can remember that I've got 40,000 owing and I know in January I'm going to chase him for it. It's not a problem. But as your business gets busier and you have more and more transactions, it gets harder to manage. You might have 15 different invoices out. They might all be due at different times. You could have 3 suppliers or more that you owe money to. So you buy stuff in one month, they'll send you a statement at the end of that month, and then at the end of the next month, you've got to pay them. You can have several different suppliers, lots of different customers, wages to pay, expenses to pay, fuel to pay. It becomes very messy very quickly. And if you don't have a very clear system, it's very hard to know exactly what's what. Everything in bookkeeping is this. It's one value moving from one place to another. Debit on the left, where money goes to, credit on the right, where money comes from. One picture, one transaction, every time. This system is called double entry bookkeeping. Double entry doesn't mean that everything's entered twice. It means that every transaction has at least 2 effects. It's often meant to sound more complicated than it is, but as we've just seen, it's really, well, the logic's really quite straightforward. It's the basis of all modern accounting, and everything else we do in this series is based on this. In the next episode, we're going to sort these T accounts into 5 simple groups. And once you understand those 5 groups, everything starts to click. See you then.